If you'll indulge me, I want to begin with a personal anecdote. It's mostly targeted to the academics in the audience. So 36 years ago, I began my scholarly career as a doctoral student in economics at the Stanford Graduate School of Business. While I'm sure I benefited a lot from it, I don't remember much specific from my year and a half as an economist before I switched to accounting. But there is one thing I remember, which is the faculty advisor to the students there, an associate professor, not yet famous, studied the Great Depression and other financial stability-related issues, told all the doctoral students that we shouldn't just be technocrats, we should try to use our knowledge to influence public policy. I've remembered that ethical nudge over the course of my career. I write a fair number of accounting policy papers, and I always sort of feel good about myself doing that. In the meanwhile, this associate professor became famous, the chairman of the Federal Reserve during the financial crisis, and he, along with others that were similarly minded, somehow managed to save us from another Great Depression. And I realize we're all here to sort of remember and think about the consequences of that 10 years ago. But actually, what I remember, and the reason I'm happy to speak at this conference, is the nudge. It's, this conference, if it's going to do something useful, it's going to nudge future research, it's going to nudge future policy interactions of faculty. Okay. So I never get to the end, so I'm going to do the bottom line now, which is bank financial reporting requirements and also the practices around those requirements affect financial stability, but in complex ways. And if you read the newspapers or listen to people speak, the effects are often misunderstood, they're overstated, they're mischaracterized. If you're going to think about the effects of accounting on banks, their decisions, on financial stability, you have to think very carefully. So I've written two articles for the annual review, one last year, one this year. The editors wisely put the first one in the compilation because it's broader and more general. I'm going to mostly talk about that one. It talks about the main financial reporting issues, which are loan loss reserving, fair value accounting, and securitization accounting. It talks about the channels by which financial reporting can affect stability. And there's three main ones. One is regulatory capital. Regulatory capital is based on accounting requirements mostly. The second is internal discipline. So accounting requirements can require banks to develop systems or hire personnel or get information that helps them understand their risks better. And if they understand their risk better, they make better decisions. And then lastly, accounting provides information to users of financial reports, which includes investors, regulators, and others. And that can provide external discipline on banks. So I'll talk about those accounting issues and the channels, and I'll also talk a little bit about the research that's sort of provided evidence about those. And then if there's time, and there may not be, I'll talk about the current one, which paper which is talking about recent research, some of which I've done, some of which other people have done, that tries to sort of refine our understanding of these issues and channels. So first, loan loss reserving. Currently in the US, we have something called the incurred loss model, which has gotten a lot of bad press. And the incurred loss model has three conditions for accrual of loan losses. One is the loss has to be incurred, which means rooted in the present in some fashion. Another is it has to be probable, which is a high probability threshold for recognition. And the third is it has to be reasonably estimable. And people often focus on the incurred part as if it's somehow unusual, but actually it's a very typical condition in accounting. Something has to have occurred that's rooted in the present that gives rise to accounting recognition. Maybe incurred is interpreted, specified too strictly, maybe it should be weakened, but it can't be eliminated, otherwise we're not doing accounting, we're doing something else. Okay, probable, on the other hand, clearly unnecessary. We do fair value accounting now. Fair value accounting will take any probability, no matter how small, and incorporate it into the fair value. Probable is just a completely unnecessary condition. And then lastly, reasonably estimable. Reasonably estimable is also sort of a necessary condition. We can't put a number on something unless we can reasonably estimate it. Maybe it's interpreted too strictly like the incurred condition, but it can't be eliminated altogether. So what the FASB and the IASB internationally have done is they've come up with this notion that banks should make reasonable and supportable forecasts of the future and incorporate those forecasts into the current loan loss reserves. Okay, that's weakening the incurred condition, it's weakening the can be reasonably estimated condition. Historically, we haven't made such forecasts. they get rid of the probable condition altogether. Okay. So there were allegations made during the, actually they've been made periodically over time, but they were made in the crisis, that the problem with the incurred loss model is that banks reserve too little for loan losses in good times, and therefore they have to reserve too much for loan losses in bad times. And it's the increased reserves in bad times that drive instability, that reduce their capital at an unfortunate time, that cause them to cut back on lending, that has systemically bad implications. Okay. Personally, I've never found this story particularly credible because it requires banks to believe their own accounting. They've got a whole lot of information about their loan performance, non-performing loans, delinquencies. They've got a whole lot of information that's not accounting information. Somehow they ignore all that other information. They just focus on their accounting numbers. There's some research that suggests that these allegations are true, but probably overstated. The most famous paper in accounting is by Beatty and Liao in 2011, which measures the timeliness with which banks estimate loan loss reserves. Timelier means in good times they'll reserve more. Because they reserve more in good times, they'll have to reserve less in bad times. And they find that loan loss provision timeliness is associated with good decision making. Banks issue more capital both in good times and bad times. They make more loans in bad times. Okay. Whether or not it suggests that it's actually the timeliness that gives rise to the decision making, though, is in doubt, because there's a lot of other reasons that could drive the results. For example, it may just be that well-managed banks have both timely loan loss reserving and make good decisions, and it's not the mechanism. Timely loss reserving isn't the mechanism, it's just associated with the mechanism. And so you can think it's quality of bank management, or the quality of the bank's information systems, or the credit risk modeling systems, or market discipline is higher for some banks than other banks, or bank regulation intensity is higher for some banks than other banks. It doesn't have to be causal. My main reason to think, though, that it's the loan loss reserving effect is not primarily driver is accounting standard setters are only going to allow a relatively narrow range of approaches to loan loss reserving as acceptable. So the incurred loss model they can think of as acceptable. They're going to move to an expected credit loss model that's going to be acceptable. The changes in loss reserves that'll come from moving from one acceptable model to another acceptable model are not that large in terms of affecting capital ratios or in terms of the amount compared to the ex post realization of credit losses when times go bad. Okay. Now you could come up with other unacceptable accounting approaches like what's called dynamic loss reserving, which is you use through the cycle loss rates to estimate credit losses. So if you're in bad time, you assume times are going to get better. In good times, times are going to get worse. No accounting standard setter is going to go for that because it's completely unrooted to the present. Okay. Okay. These allegations, in any case, cause both the IASB already and the FASB to be effective in 2020 to move to an expected credit loss model. Okay, they've gotten rid of probable, reasonable, and supportable forecasts. This will definitely increase loan loss allowances in good times. And so you might think this is going to be counter-cyclical because that means that they have to reserve less in bad times. My personal belief is this is going to be pro-cyclical. And the reason why is the way the expected loss reserving model works is you write a loan for 100, you have 5% expected losses, immediately you write down the loan to 95, and you take the 5 loss, you reduce equity, you reduce regulatory capital, you reduce income. You're sitting in bad times, you're a bank, your capital is in doubt. Do you write a loan and take the $5 hit to income up front? I think it is unlikely. So there's strong incentives if you front load losses that you will reduce the incentive to lend in bad time, which is going to be pro-cyclical, not counter-cyclical. Okay. Okay, so that's the first one. Second one is fair value accounting. The allegation was made during the crisis, which is absolutely true, which is illiquidity is market breakdown. And so if you require firms to write down assets to fair values, which are reduced by market illiquidity, then what you're going to do is overstate the loss to a firm that's capable of holding the position either to the recovery of liquidity or to the maturity of the instrument, whichever comes first. Okay, that's absolutely true. Okay, sorry, missed my notes. Okay. In fact, there were actually some people, like Stephen Schwartzman, who claimed that the fair value accounting was the primary cause of the financial crisis. While I think there's truth to the illiquidity story, this is clearly an overstatement. And the primary reason is that banks do not hold very many assets at fair value. Loans are not at fair value. Held-to-maturity securities are not at fair value. Available for sale securities are at fair value on the balance sheet, but for all banks back during the financial crisis and most banks now, gains and losses on those assets don't affect capital. So what you're left with is derivatives, which only big banks hold, and trading positions, which only big banks hold. Those are the only positions that are fair valued, and their effects on even the big banks' balance sheets are quite small. So by definition, if the crisis is a banking-related driven crisis, it can't be fair value accounting. And in fact, accounting standard setters haven't really messed too much with fair value accounting. The main change they made is to other than temporary impairment accounting, where they didn't require firms to write down impaired securities all the way to fair value and record the loss in income and capital. Instead, it's only to the present value of the cash flows. And so they ignored the illiquidity effect. This also doesn't have much of an effect on banks, because banks don't hold too many securities, maybe 15% of their balance sheet. Most of the securities they hold are low credit risk, not high credit risk. Illiquidity is not a problem. In fact, during a crisis, low credit risk securities actually benefit from flights to quality. And there's a paper by Bitch and Shea that shows that, in fact, gains and losses on available for sale securities are, in fact, countercyclical, not procyclical. Okay. And then the third area is securitizations. It is true that up until 2010, the accounting rules, and there's two important ones. One governs sale versus secured borrowing for securitizations. The other governs consolidation of securitization entity. Together, they basically gave rise to off-balance sheet accounting for virtually all securitizations. The only exception of note was certain multi-seller asset-backed commercial paper conduits. And for regulatory purposes, even those conduits were off balance sheet. So basically, we had accounting and regulation based on the accounting that ignored leverage associated with securitizations altogether. And so the FASB wrote some new standards. And so the allegation was that because of this, banks didn't pay enough attention to their lending. They lent too much, they lent too risky, they got too levered, things like that. Okay. I think it's absolutely true that the old accounting for securitizations made no sense. The biggest problem was that banks would retain the tail risks of securitized assets through liquidity support or credit support or something like that. Most of the time, these tail risks don't materialize, and it looks like the banks have sort of given away all the risk. But in crises, these risks materialize, and the banks bear all of the risk of the underlying assets. Okay, so there's research that suggests that some of these allegations are true, but to a close approximation, the only banks that securitize are very big banks. So if this is a problem, it's a problem that's related completely to big banks. Even for big banks, even in relatively bad times like 2010, when these standards became effective, consolidation of entities affected their capital by anywhere from 0.5% to 2%. So it took banks that were very well capitalized and made them still well capitalized, but a little bit less so. Okay, so this is a pretty major change in accounting. It's actually the biggest change I think the FASB's made, and yet even this has relatively small effects on banks' capital. Okay. My personal, I think I haven't been, sorry, I'm very bad at this. My personal belief is that if you think that the problem is banks lend too risky, accounting is not the right way to convey that information. The right way to convey that information is by disclosure at the loan level of the types of loans that banks make. And in fact, we have a disclosure requirement starting in 2016 for securitization entities, where they must disclose at the loan level the underlying loans FICO scores, loan-to-value ratios, documentation, and so forth. And so now market participants can see if there's risk layering going on or risk barbelling or something else that's problematic in the underlying assets. Okay. How are we doing? I think I've got 2 or 3 minutes. Okay. The FASB did change securitization accounting. It's not that everything's consolidated now. It's not that everything's on balance sheet. In fact, there's 2 main types of securitized assets that are on balance sheet. That's credit card receivables and asset-backed commercial paper. Pretty much all other types of securitization entities remain off balance sheet. That includes subprime mortgage entities, residential mortgage entities, commercial-backed security mortgage entities, and so forth. Okay. Okay. So there are 3 channels for accounting to affect stability. The channel that most research has thought about is the regulatory capital channel. And I think it's true that this channel is sort of usually in play for most accounting issues. But in my opinion, it's actually not typically the main channel for reasons I've mentioned, which is that accounting doesn't have that big effects on regulatory capital. A good setting where regulatory capital is the mechanism, though, is that the US implementation of Basel III removed the AOCI filter for advanced approaches banks, which are the biggest banks. So these banks now, when they have unrealized gains and losses on available for sale securities, those gains and losses now hit capital. That makes their capital more volatile. The AOCI filter has no effect on internal discipline or external discipline because it doesn't change the information available either inside banks or outside banks. All of the information is the same as before. And so just to give you a sense for how complicated I'll end with a slide, for how complicated the effects of even this very simple change in accounting requirements is. The removal of the AOCI filter had 2 direct effects. The first is the advanced approaches banks had incentives not to classify securities as available for sale and have gains and losses hit capital, instead to classify securities as held to maturity, which gets cost-based accounting and no regulatory capital effect. So that's a direct effect. The problem with held to maturity security classification is you can't sell held to maturity securities without tainting the whole portfolio. So even though the securities may be liquid, you've effectively made the securities illiquid if you don't want to taint your held to maturity securities portfolio. So if you want to raise financing off of the held to maturity securities, you can't sell them. Your only option is to pledge them in repurchase agreements accounted for as secured borrowings. And so what you find is that the big banks, they classified securities as held to maturity, and they increased their repurchase agreements as a substitute for selling securities when they needed liquidity. Second indirect effect is repurchase agreements aren't as good as sales of securities to provide liquidity because they are shorter term. You have to keep rolling them over. Only works for good collateral. And so their ability to raise financing goes down. Because the financing goes down, advanced approaches banks lend less. That's the second indirect effect. The second direct effect is that banks have the incentive to decrease the risk of their securities. They can either classify securities as available for sale securities, in which case volatility hits regulatory capital. They don't want that, and so they reduce the risk of their available for sale securities. Or they classify their securities as held to maturity, don't get volatility of regulatory capital, but now you've got securities that you can't manage the risks of as well, and so you want to reduce the risks of the held to maturity securities as well. Once you've decreased your securities risk, that's reduced your interest rate spread. You reduce your interest rate spread, you try to get it back up. How do you do that? You increase the risk of your loans. Very simple accounting treatment, a whole cascade of effects. If you want to think, is the AOCI filter removal good, bad, or indifferent, you have to think through the whole cascade of effects. Okay, I had 2 more slides, but I'll end here.